Hi, and welcome to Coin Toss, the show where we respectfully and vigorously discuss the big questions within our modern, financialized, and increasingly tokenized world. I'm Adam B. Levine, CoinDesk's managing editor of podcasts and your moderator for today's session. On this show, we're digging into the intersection of crypto companies and Wall Street. With the bull market in full swing, NFT mania top of mind for everyone, and frothy markets hungry for any good news, a growing array of crypto companies are pushing towards public listings or something like it. But the one furthest along, expected to be first to market, is Coinbase. Founded in 2012, Coinbase was Bitcoin's first real dollar on-ramp that made it simple for normal people to buy Bitcoin with their bank accounts. Just today, the company revealed in their updated S1 filing that they'll be offering nearly 115 million shares with a maximum raise of $943 million. Later, we'll broaden the conversation and explore other companies headed towards publicly traded status with a brief detour into security tokens and who knows what else. For today's discussion, we're honored to be joined by Lex Sokolin, global fintech co-head at ConsenSys, a Brooklyn-based blockchain software company. Hi, Lex.
Hi there.
And David Traynor, CEO of investment research firm New Constructs. David, welcome to the show.
Thanks, Adam.
Okay, so I mentioned in the lead-in that while a number of crypto companies are now discussing going public, Coinbase looks likely to be the first mover. They recently made a lot of data about their inner workings of the company public in their S1 filings, and just as I said, released an updated S1 today, which we haven't had a chance to dig through. So we know a lot more today than we did at the beginning of the year. And perhaps more importantly, insider shares auctioned through NASDAQ private markets have gone for prices that imply a valuation as high as $100 billion. David, let's kick things off with you. At least in theory, smart money thinks this is going to be big. When you're looking at Coinbase, having read their S1 and dug into the guts of the thing, is this a $100 billion number? I mean, is that fair? And if not, what is closer to a fair valuation in today's markets?
It's in today's markets, in terms of fair valuations, they're really, it's a tough measuring stick. But when we look at Coinbase in general and just kind of doing the math in terms of what's required for the business in terms of cash flow performance, earnings performance to justify the price. And $100 billion looks, maybe a couple times bigger than what it really ought to be. Coinbase itself is not a sort of an unusual or special technology. It's an exchange for cryptocurrency. And so what we did is we modeled the crypto exchange market, compared to the other exchanges, and looked at margins for companies like the New York Stock Exchange or ICE Data Intercontinental Exchange, and NASDAQ. And what we see is, like, in a mature market, margins for an exchange business like Coinbase is probably 1/50th of what it is right now. And so the implication of $100 billion valuation is that Coinbase would be bigger and more profitable than both the Intercontinental Exchange and NASDAQ, significantly more. And we think that's probably a little bit rich. We think that that's probably just based on a lot of the hype and excitement around crypto and blockchain, which themselves are excellent technologies. But Coinbase, on a standalone basis, really doesn't have a special technology or anything that we think is going to allow it to earn margins that are over 50 times greater than their more mature peers in other exchanges.
So, Lex, let's bring you in on this. Again, like, I read an op-ed that you published in CoinDesk about a week and a half ago. So kind of talk to us about the other side of this argument, because everything David's saying sounds frankly fair to me. Won't margins fall? Won't we see sort of the profitability and the excitement around the sector, which seems to be pretty cyclical? Isn't this just kind of like a good opportunity, but maybe not a real price?
That kind of goes to what is a real price. And I think on the substance of things, I totally agree with David about the long time horizon for the technology and sort of the cooling of the space that could happen. But one of the most important things is to market. And the delta that we see between how people feel about Coinbase or how people feel about Tesla versus how people feel about whether it's ICE or whether it's the New York Stock Exchange or whether it's Ford, there's a really big order of magnitude difference. And you can also point to the fintech private markets, where companies trade at 20 times to 50 times on revenue, and you can pull up 50 different comps for that type of private financing. And then you can look at the public markets where bank stocks and financial stocks or exchanges. You might be trading on EBITDA, or you might be trading on book value or other things that are sort of more core operating metrics. And so there's two markets, and they come with different values, and they come with completely different worldviews, and both are real. But it seems that in the moment right now, especially with the direct listings and the SPACs going on, it's really the fintech market that's setting the pace of the offerings. And so, 20x to 50x on revenue for a hot sector like crypto exchanges does seem in line with where we are. But of course, there's a lot of work for growing into that valuation. The other part of the bull case is, sort of like the robo-advisor wave and the digital investing wave that was supposed to take over our lives. And to me, the realization is it was never about that. It was always about access to digital assets and about Coinbase. And so if you look at the 43 million users, in a sense, for Coinbase relative to the 10 or 15 million at Robinhood, or the couple of million at Betterment and Wealthfront, it is very clear that the next generation has chosen Coinbase and access to digital assets as the next Schwab. And so I think that's very much embedded in the valuation. It's high, but it's a matter of the moment.
Okay, so both of you made comments about kind of the current market environment that we're in, keying off of something that I said in a question to David. And frankly, I think that that's worth digging into. I mean, in the last year, we've seen markets go from being a kind of loose reflection of reality to being completely distorted by Fed action and government action around the world. So, I mean, like when you're looking at a company like this, I mean, or just any company in this current environment, like what still matters? What are the things that actually do matter in these markets when Fed intervention is so persistent and pervasive? And David, let's go to you for that.
Yeah, I know. Look, I think Lex makes some great points on what the current market environment and the disconnect, and I think probably a good analogy for what we're seeing here is the emergence of new industries and technologies in the past. Like just say, for example, our friends at Research Affiliates wrote an article on how the car industry started, several years ago. And in the beginning, the valuation of the first initial cars were high, and you lost money if you kind of put in the original sort of car manufacturers. And as that business matured, it became a low margin business, and that effectively that's where Tesla is headed as well. And so, to Lex's point, this is a frothy market. Look, and as long as the Fed is dropping and the government is dropping billions of dollars into the economy to be spent, and we know a lot of those stimulus checks are going to go straight into the market or into crypto, whatever, into some sort of investment market. That can sustain extended and valuations untethered to fundamentals for a long time. And the question is then, well, for how long? And that's the one that's tough to guess. And it's also tough to see your colleagues and peers making triple digit returns every year, every month, while you try to play it safe. And so I don't have a great answer, Adam. I think Lex is right. There can be two different markets. And as Warren Buffett likes to say, the market can remain irrational longer than, and certain investors, short investor in particular he's referring to, can remain solvent. And I'm not saying people should short this, but it's tough to know when it will reconcile back to fundamentals and if that ever happens.
Well, so Lex, I mean, what David's saying there is that, like he doesn't know, but like, is it narrative? Is story the thing that really matters and is driving markets today, you think?
Listen, I kind of grew up on the asset allocation methodology. So people should be smart. They should figure out their goals. They should diversify. They should have some allocation to tactical opportunities. And within that, buy one NFT and things will work out. But it's also, we're in this moment where the last thing you want to do is short Coinbase. I mean, have we not learned our lesson about the internet slapping around hedge funds on things that are popular? And I think there's definitely there's a question of whether the untethering from reality is permanent or not. I think most reasonable people will say it's not permanent, but I think also most reasonable people would say we would not have now 12 years of quantitative easing and money printing and government subsidy of corporate balance sheets that has resulted in the highest Shiller PE ratio of all time, right? So I think the way the macroeconomic machine is running is creating these outcomes, and so even the notion of fundamentals is quite messed up at the moment, right? So if you take a discounted cash flow for any of these companies and you raise the rate from 0.1 to 1.5, you're going to slash the value of the companies in half more, right? In terms of the actual model. And so it's a really tough environment to, I think, to be short because there is also the momentum of the meme and the momentum of the internet and the momentum of the story, and I think just kind of the last bit on this is as we see crypto assets hit 1 trillion, hit 2 trillion, if not more, we also start to see that value creation isn't only captured by the financial instrument of an equity share, and that value capture can sit inside of a token. And tokens are much more like internet memes than they are, securities in many cases. And so I would just advise people to be careful and to be very tactical in their exposure.
And no financial advice on this show, but good kind of precursor for our next segment when we will talk about security tokens a little bit, because I'm pretty interested in them too. Okay, cool. So we're almost out of time here. I got a ton more questions, so I'm going to skip around in kind of my plan. So David, just real quickly, I don't understand how stock markets work. Coinbase is doing a direct listing as opposed to doing a traditional IPO. What does that mean? Why would they want to do that?
I think mostly you do that because you want to avoid paying the investment bankers their 2 to 3% fee of the overall IPO or listing. It's also if you believe you have plenty of confidence in the number of people to whom you can distribute the shares, so that it will automatically all the shares you want to sell effectively get bought up. And so it's mostly about saving some money and kind of not going through the good old boy system in the way that most companies tend to.
Well, and it sounds like with as hot as kind of the sector is right now, that a lot of it is about sales, right? Like they don't need help selling the offering, therefore they don't need to give that money to the bankers. Is that kind of your figure in here?
No, that's exactly right. And I think this speaks to a bigger picture, around this fundamentals and transparency and if how long things can remain untethered. And I think a big part of what we're seeing here is an analogous movement, not just towards digital currency, but towards technologies that are going to help investors make more informed decisions about investing. Because right now, the traditional Wall Street distribution and research process is not about really investors that much. It's about helping the company sell stock. And so I think that these direct listings are effectively saying, look, we don't need any hype. We've got enough hype, and the research that comes most from Wall Street is really not about informing investors. So what do we need you for?
Okay, well, that makes sense. Thanks for clarifying on that. Lex, we're about to end, but you got about a minute and a half. So Coinbase made public some of the risk factors, and there were a bunch of them that were interesting to me, but perhaps the biggest one that really jumped out was their concern around decentralized finance, better known as DeFi. Now, I think we've got a graphic for this if the studio can pull it up, but basically, if you look back at the history of Coinbase. Coinbase has been around since 2012, and they've done about $450 billion worth of volume in that time. That is an impressive number. But as you can see on the screen, Uniswap has just been out, which is the biggest DeFi exchange protocol, has been out since about 2018 and has already done more than $100 billion. This tweet is celebrating that. So, I mean, Coinbase is bigger, but DeFi just in this one platform seems to be growing at a faster clip. Is that something that Coinbase should be concerned about? And how, if anything, do you think they ameliorate that risk?
Yeah, so real on-chain technology is an existential risk for any company which is running a custodial model, right? Like a brokerage model where things are being done for the customer. So for reference, Ethereum now has 150 million, give or take, addresses. It is about 50 billion in USD dollar denominated stablecoins. It's got 45 billion of collateralized assets, assets that are backing various economic protocols. So Ethereum is bigger than Coinbase for sure. It has the ETH token, which is quite valuable, also more valuable than Coinbase. And then within that ecosystem, you've got at least 20 protocols, DeFi, decentralized exchange, lending, stablecoin, insurance protocols that are replicating the functions of the financial services industry, but they're doing it on an infrastructure which is modern and is digitally native. And so if you think back to sort of like the Robin Hoods and the Betterments and the Wealthfronts of the world, they're like a Spotify of CD-ROMs. They're trying to sell digitally old financial services products, whereas DeFi is able to do that on chain in a permissionless way. And so Coinbase has to chase this functionality. They have to figure out a way to integrate it, and that is a real, I think, black swan threat to their economics in the long run. But having 900 million to go and do acquisitions is certainly going to help.
Yeah, I imagine it will. Okay, so that's it for our first topic. Stay tuned for after the break. We'll be back with a conversation about de facto ETFs, so-called SPACs, and security tokens. I'm Adam B. Levine, and we'll be right back with more Coin Toss. Welcome back to Coin Toss. I'm Adam B. Levine. Once again, we're joined by Lex Sokolin and David Traynor. Welcome back, guys.
Thank you.
So in our last segment, we discussed Coinbase as they prepare to morph into a public company. But now let's draw back the lens and talk about the broader, perhaps emerging sector. For as long as I've been watching, people have wanted ETFs for Bitcoin, and to a more recent extent, for Ether too. Many have tried, in the US at least, and none so far have succeeded. But starting perhaps the middle of last year, that's been changing. As first MicroStrategy's CEO Michael Saylor and then a growing proportion of publicly traded companies started swapping their cash for Bitcoin, tying their share price to the asset at least partially. And then, of course, more recently, we've seen a number of actual Bitcoin ETFs approved in Canada, which again brings the question, Lex, and I'd like to start with you. Does the US need an ETF for Bitcoin anymore? And we can talk about Ether in this too. And if we do you think they're coming?
Yeah, so for sure, the U.S. needs an ETF structure, and it's not to access the asset class. We can, as individual investors, and then as even institutional investors, as asset managers, we can access Bitcoin and ETH, right? We can go on a crypto exchange and buy directly for ourselves and just hold Bitcoin. You don't need any contrived sort of company that indirectly correlates to it. And then as an institutional investor, if you can go into hedge fund structures or if you can go into trust structures and you meet the requirements, then there's lots of packaging of these assets for you in all sorts of delicious ice cream flavors. What's missing, and the reason why ETFs are important, is that ETFs are a gear in the investment management industry that plugs into a whole machine, a whole value chain of getting assets from Main Street into asset allocations and into retirement portfolios. So if we want crypto assets to be treated as any other boring asset and represent 5-10% of America's portfolio, you just need the ETF, and it will plug into performance reporting software. It'll plug into portfolio management software, and it'll plug into traditional custodians, and it'll plug into about 4 trillion of financial advisor intermediated assets that right now are still kind of lacking an on-ramp into the asset class. And so I think it's massively important, not necessarily for early adopters, but for the normalization of the asset class. And, I'm an optimist, so I definitely do think it's coming, just because in Europe, there are multiple exchange traded notes that represent crypto commodities. So it's getting embarrassing, right? Like we're late to the party at this point.
That's fair enough. So I think we just got the kind of crypto native view on things. David, jump in there. What do you think about it from a traditional markets perspective?
Yeah, I think it's a great point. This is all about really kind of allowing and the cryptocurrency to more directly enter the natural flow of assets. And the ETF is a vehicle that, as Lex said, is a good on-ramp to allow more investors access and more sort of investing processes to access the cryptocurrency market. And, the ETF structure, again, it's something that can easily plug into asset allocation software and other investment programs that are getting money on a sometimes automatic basis or rule-based basis. It allows them to sort of become part of the overall asset allocation pie. And so it's really just about packaging and enabling access to crypto. And I think we live in a world where that's something that is bound to happen. They don't let the packaging get in the way of money flow. So I would agree with Alex that it's inevitable.
So let's turn to a slightly more nuanced topic, which is kind of the idea that, so like I've said a couple of times here, a number of crypto companies are kind of preparing to go public. Another one that is preparing to go public, but which is not a native crypto company, more one that kind of walked into the sector a couple of years ago, but already had an existing business, is eToro, which is a large kind of traditional equity trading platform that's also added features around tokens long before kind of the current crop of them had. Word came out this week that they are planning to go public using a SPAC, as they are called. And once again, I don't understand markets. So David, I'm going to lean on you here. What's a SPAC? Why would they go public? And the deal itself is valued at $9.6 billion and includes both a traditional, exchange business, which Coinbase does not have. And then in addition, crypto features and functionality on that side. So just kind of weigh in here generally, what's a SPAC and what do you think of this kind of as a broad offering approach?
SPAC is the definition, special purpose acquisition company. Shell business that has no underlying operations except that it's publicly traded, and it can then go use the money it raises in its own initial publishing to buy companies that by definition of being bought by a public company now become public themselves. So it's sort of a backdoor way to IPO without going through a lot of the regular processes. And I think, SPACs are in the land of very high valuation and untethered to underlying economics. And we're interesting things going on where I think a few SPACs have gotten hammered pretty hard when they've reached a little too far to take certain companies or bring certain companies public. And so, it's really just kind of placing an additional layer between the company that's actually going public and the investor. The SPAC is this sort of middle layer of investors or managers, almost like hedge fund managers, who you're giving money to then use that money to go buy companies that will in turn go public. So it's probably long-term, most SPACs will be sort of mini kind of companies that they're invested in a lot of different other companies. And so it makes it a little bit less transparent, makes you do a little bit more work because you're going to have to understand each of the underlying businesses as you do with a conglomerate, a big company that has multiple business lines. And less transparency, but it allows these smaller companies to go public more easily.
Let me jump in there. So is this another way to avoid giving the big investment banks their 2 to 3%? Because that's what I think I mostly heard from what you said.
I think that they're getting it when the SPAC goes public, so they're probably getting their share there. If it's a traditional sort of IPO.
Okay, cool. So we are unfortunately almost out of time. We just got a couple of minutes left. So I really want to get to securitized token offerings. These are blockchain tokens that companies, at least in theory, sell to raise funds, typically to accredited investors only. They have lots of restrictions on them, like traditional equity, because in the eyes of the law, at least in the US, they are traditional equities. These can represent actual equity, access to revenue streams, fractionalized interest in collectible NFTs that are worth $60 million, or really anything else that you can legally do with SEC approval, at least in the US. So, Lex, we've heard a lot of talk about STOs, securitized token offerings, over the last half dozen years, yet there are surprisingly few of them that have been released. As crypto companies start going public, and start to actually reach that point in their cycle, has the time for securitized token offerings finally come?
So let's blend together all the demand for token offerings, right? Starting with the Ethereum token offering itself, and then leading towards the sort of the ICO growth in 2017, and then regulatory clampdown. And then it's about that time that smaller mid-sized companies started talking about doing crowdfunding their securities the same way that you would, on Kickstarter for an arts project, you can do equity crowdfunding. However, the equity crowdfunding sector hasn't really been a large success story, mostly because of the lemons problem of the type of securities that they're offering, and generally it's hard to understand kind of that middle market. And so STOs around 2018, 2019 had a lot of infrastructure that was built to marry, let's say, the traditional markets and the crowdfunding exemptions together with crypto-based architecture. And so that work has been done. And I would say in 2021, there's two dimensions, and they're rather separate. I think the equity crowdfunding in the middle market is not the answer. It's an answer and it's interesting, but it's not the answer. It's a transition point. And I think the two answers that we see, especially from the view of ConsenSys, which works with the large banks like JP Morgan and essentially the rest of Wall Street on the enterprise side, is that the securities inside of institutional capital markets, so large bond offerings, green bonds, or large real estate offerings, things of that nature, those are being put on blockchain networks in consortia. So for example, Comgo, Covantis, the JP Morgan settlement coin, all of those run on Quorum, which is the enterprise Ethereum version. And then on the other side is still the crowdfunding. Like, what is it? How are you funding a project? And at least I personally see a lot more assets go into figuring out how to fund tokens that correlate with the economics of the network, but which are not meant to be structured as securities, but rather which are meant to grow a decentralized autonomous organization, like whether it's MakerDAO or any others that are emerging. So the organizational structures are different, and therefore some of the value accretion is different. And I think increasingly we see those types of token launches be more successful than STOs just on their own.
Thanks for that context, Lex. So, David, I actually prepared a Reg D STO way back in 2017, in the winter of 2017. And I got to the end of that process and I discovered that compared to any other type of token I'd ever looked at, they were incredibly crippled because they were basically, they had all the restrictions put on them that you needed to have a security, right? And because of that, the marketability of them, the audiences that were available to them or that you could even offer them to and how you could offer them was very kind of restricted. I spoke with, I believe it was actually Bruce Fenton, who explained to me that one of the big reasons why these things are useful is because they allow a company to go public in a compliant way without going through the trouble or potentially problem of getting listed on the New York Stock Exchange, the NASDAQ, or another market. Effectively, tokens mean that you can use them with any market that's compatible with tokens. I've always wondered, is that actually a problem? Is this like a real reason to use security tokens so that you don't need that listing, or is this kind of like a solution looking for a problem?
I think it speaks to what Lex said before in terms of how crypto can change the investing business in a really big way. And that is to, just to decentralize things away from the traditional exchange and go with a blockchain technology that doesn't have the 2-day sort of the GameStop issue and the other sort of traditional processes that are part of the exchanges. And so I think we're ways off from that, but there's a lot of potential there to really move to a new world, a new model where it's all done on the blockchain. And you don't need a lot of these traditional big exchanges to distribute. That's sort of an old school way of manually distributing shares. And what we're seeing in these STOs is sort of people starting to look toward that future and see that as a reality. And I think it could be really powerful.
Well, folks, that's all the time we have for this episode of Coin Toss. Thanks again to our guests, Lex Sokolin and David Trainer. You can tune in every Wednesday to new episodes of Coin Toss at 7:30 a.m. Pacific, 10:30 a.m. Eastern, with new debates and reasonable people saying occasionally, but not usually, unreasonable things. Coming up, stay tuned for The Hash at 12 p.m. Eastern, 9 a.m. Pacific. I'm Adam B. Levine, and until next week, keep the conversation going.